Good afternoon. I'm Brandy Ward, a wealth manager here at Windward, and I'm joined by Drew Osborne, a certified financial planner and senior wealth manager. Thank you for joining us today as we talk about bear markets. At the end of our discussion, we'll be answering a few questions. So if you have a question you'd like us to answer, please feel free to send it through the chat feature, and we'll try to get to it at the end. We know that investing in the stock market comes with risk, but that risk feels very real in times like these when we have officially entered into a bear market. A bear market means that the stock market's closing price has fallen 20 or more % from its recent high. And since 1929, we've experienced 27 bear markets. 27 may sound like a lot, but it's important to understand that the stock market is cyclical in nature, and bear and bull markets are both features of a healthy stock market. We've experienced a long, healthy bull market, and as we enter a bull market, as we enter a bear market, what are some things to know?
Yep, it's a good introduction, Brandy. It's fitting for us to do this here after the market's closed, to close out the first half of the year. The worst first half year for stocks since 1970. So 52 years, and here we are, the worst first half of the year. A punch in the gut in a lot of ways, but important to just kind of get a scope of what bear markets mean. Like you said, we've had a really strong bull market for quite a while. So have a couple slides that we'll talk a little bit about. This first slide that Brandy's going to bring up here in a moment is just kind of trying to say, how long do bear markets typically last? So everything that we're talking about is historical, looking backwards. What that means for this bear market, nobody knows, since the future is unknowable. But you see my notes kind of on the left there to summarize the chart. From the high point to its low point, the peak to the trough, the average bear market to get down to its low has typically taken a year. And then from there, it's generally taken 2 years to get back to that prior peak. So it's generally taken a year to go down, and it's generally taken 2 years to go back up. So to the right there are all of the bear markets that have happened since World War II. Like you said, Brandy, there's more than that overall in the market, but this just highlights the last, however many, 12 or so of them. And there's examples where it's gone down faster than it, it's taken a lot less than a year, like in 2020, which was when COVID hit. The market dropped really hard, really fast. It only took a month to get down. And there are examples where it's taken longer than that. You can see 2000 was one of the more recent examples where it took a long time to get down to minus 20%. And then to the right, to say how many months did it take to get to break even, to get back, you can see that there's a range where it happened quickly, like in 2020, it only took 6 months for the market to recover, or it could take 4 years, like it did in 2000. In both of those extremes, or you take the average together to say that it takes on average 2 years for a bear market to get back to its prior peak, that information, in my view, is just comforting to know. A, markets are cyclical. Sometimes they go up, sometimes they go down, but they're not forever. If they were always down, we don't know how long it's going to take, but we know that cycles come and go. So next slide. I thought this was also kind of interesting. Both of these slides came from Ben Carlson, who's in the advisory industry, and he had a good kind of post kind of asking some of these questions, saying, okay, once you hit a bear market, minus 20%, how much longer does it take to get to the bottom? And I thought this was a good question because most folks that are investing are like, I am going to stick with this. I'm going to tough this out, but my gosh, how much farther is this going to go? Because it can feel really, really tough. So along the left summarizes it. The main points are that it typically takes longer to get to -20 to get to a bear market than it does on average to get all the way to the bottom. And that second point's the same as it was on the prior page, is that it generally takes 2 years to get from the bottom back to the break-even point. So when I look at the chart to the right, you know, the days down to 20% on average, it's 236 days on average. But then the days from that 20% down to the bottom was only 131 days. So on average, it's taken a lot less to get to the bottom than it has to get to a bear market. Doesn't guarantee anything of what necessarily is going to happen from here, but it provides some good context of what is normal for a bear market. So those facts were helpful for me when I was just gathering information, just thinking about bear markets. It's important though to ask, you know, what do we see? What things do we pay attention to about what the future may hold?
Yeah, so when it comes to the question, what does the future hold? The short answer is we just don't know. The range of outcomes on where we go from here remains so wide because there's a lot of conflicting indicators. On the one hand, we have some things that cause concern, such as rising interest rates and a cooling of the housing market. The war in Ukraine has increased the prices of commodities and energy, and consumer sentiment is the lowest it's been in over 60 years. So the average consumer isn't feeling too good about the economy right now. But it's not all doom and gloom because on the other hand, there are signs inflation is starting to taper off, which is great. Unemployment is very, very low. And households have more cash and cash equivalents than in the recent past. Household debt as a percentage of their disposable income is up from its lowest point, but still lower than it was any time between 1980 and 2020. So what we just know is we don't believe the economy can be consistently forecast or the equity market can be consistently timed. This causes our investment committee to step back and say, are there any investment beliefs that should change right now?
Yeah, and that's the important thing, is to say, what can we control that we should take action on? What should we just be reminded of that we need to hold true on? And these points that are on the slide absolutely still hold true to us, especially when we think about stocks, when we think about companies, when we think about equities. So I'm going to read them off because I think they're that important, that we don't think the economy can be consistently forecast, that the equity markets cannot be consistently timed. So the only way to reasonably capture the return of equities is to ride out their sometimes significant but temporary decline. That sentence is probably the most important thing we'll say in this whole seminar, but it's just that important because we know it can be hard when the market's down, when you can see your account down by real dollars, to stick with it. You know, Peter Lynch, one of the best investors of our time, said, the real key to making money in stocks is not to get scared out of it, which can just be the opposite of human nature. We've made it so far on Earth because we avoid pain. We take action when something goes wrong. But when it comes to investing for the long term in equities, we know as a Windward team, it's our job to reiterate and provide consistent doses to remind and encourage our clients, stay the course, this too shall pass. So when it comes to stocks, our belief remains the same. Brady, what about other things like bonds and cash?
Yeah, so at Windward, we manage our clients' investments and we make investment decisions at a committee level. So Drew and I both sit on that committee, and a few things I'll add is in the bond space, we have made the decision not to allocate to long-term bonds, and instead we focus on short and intermediate-term bonds. Long-term bonds are more sensitive to interest rate risk, and we don't feel like we have been in a low interest rate environment for so long. We just haven't felt adequately paid for the additional risk. Additionally, we favored high quality bonds with a lower risk of default. In the cash space, cash is seeing its time to shine, which is fun. For clients in the distribution mode, we maintain a cash buffer in their accounts of about 12 months worth of distributions. We think this is a great way to ensure that there's enough cash available to meet our clients' cash needs, and it allows us not feel forced to sell an asset at an inopportune time. For clients, it can be helpful to think of their portfolio in buckets. So their cash is bucket number 1, and that's meant to fulfill financial needs in the next year or two. Their bonds are bucket number 2, and they're meant to fulfill financial needs in the next 2 to 10 years. And their equities, that's the 3rd bucket. It's definitely the most volatile, but that's meant for the future 10 plus years. So that bucket can withstand more volatility because the time horizon is longer.
Yeah, I love that kind of bucket mentality, and it helps when we try to frame time in different ways. So when we were putting this together, I was like, gosh, I want to just talk about like our view of time. And so there's a couple things on the screen. And part of this I got from Morgan Housel, who's in the financial advisor industry, and he was just using an example of talking about professional athletes. So professional athletes, especially in sports like cross-country skiing, running, swimming, rowing, the majority of the time when they train well below their maximum effort. Why? Because if you push every training session 100%, you'll get burnt out or you're going to get hurt. The goal is over a long period of time to be average in your training. You can get strong results. So the analogy then, take it to investing, is to say investing, the biggest but most obvious secret is that average returns for an above average period of time leads to magic. In the last 5 years, though, there's just so many stories of people that have gone out of their way to like maximize annual returns, take extra risky investments that have all seemed to work, take those and then double it down with leverage. But this year, that's burned a lot of people by trying to squeeze more risk for more return. So in some respect, it's counterintuitive, but people are more likely to maximize their investment gain over their lifetime if you go out of your way not to maximize annual returns. So in some sense, it's like we're 6 months of the market in the last 50 years just closed today. I don't know if other people feel this, but there could be a sense of, gosh, what do I need to do to get this turned around? What do I need to do something different? And from a time point of view, often the best answer is think about the time horizon on a much broader scale, which is hard because the news and the media, everything comes at us. Our phones and our watches are telling us time is of the essence of here right now, but the markets don't work that way. I put the picture of the home on there, not my home. Looks like a great home. But I have that because a home is often the best investment that a person makes. And I think it's simply because they're more likely to sit on it without interruption for years, possibly even decades. And it's like the one asset that people give compounding like a real chance to work. I don't very often every day say, I wonder what my house is worth today. But boy, it's really easy to find what our investments are every single day. But those are assets that I'm thinking about for decades. Why is there such a pull to see what those are, day in and day out? But ironically, Zillow, impressive company, they are notifying me a lot by email about what my house is worth. And it tugs at me. It does make me say, boy, should I do something? Is there like an action I should take? Like, I know that my emotional feelings often compel me to do the wrong thing. And so this next slide is about consumer confidence. So talking about emotions, consumer confidence is saying, how do you feel about your financial situation at this point? And so this slide shows a lot, but the blue dashed line across the middle is, so basically over the last 50 or so years, from 1971 through, I think this is May of 2022, is that the average sentiment that about 86% of people, are saying thumbs up, kind of to the sentiment of their financial situation. And what you see, if you follow along the ups and the downs, is what has been the return of, that's the sentiment. The sentiment follows the ups and downs. But at the dots along the top, there are 1, 2, 3, 4, 5, 6, 7. There are 8 dots at the top that show what was the S&P 500 at each of those peak points of the sentiment of folks. And a lot of those times the returns were either negative or quite low for the S&P 500. And when the sentiment was at its lowest points, which those 8 dots along the bottom are the low points of the sentiment from consumers, the S&P 500 returns for the following year were all double digits, and some really, really, really strong returns in there, which doesn't predict the future, but it tells us that our emotions don't always get right what's going to happen with long-term stocks. So all that really then kind of leads us to kind of step back and say, well, what can we do? What things should we consider? What actions should we consider taking based on where we are right now?
Yeah, so for clients of all ages, now is a great time to review your budget and identify expenses that are discretionary. Windward always recommends maintaining an emergency fund of 3 to 6 months worth of living expenses. And I think letting that savings account grow a little higher than your typical emergency fund is okay. Having flexibility to weather the unexpected is a great thing in a time like this. As interest rates rise, it's also a good time to focus on paying down any debt with a variable interest rate, especially credit cards. As rates rise, that interest adds up quickly. And if your emergency fund is in good shape and your debt situation is minimal, for those in the accumulation mode, now is a great time to be buying. It's an excellent opportunity to buy stocks at a discounted valuation. If there's room in your budget, it could be a good time to consider increasing your retirement contributions. When Windward builds a client's retirement plan, we factor bear markets like these in mind. Often we have clients say things like, gosh, to soften the pain a little, I think we're just going to temporarily decrease our withdrawals. Or they might say something like, I think we're going to wait until next year to go on that family trip. And while these scale backs aren't always required, it does seem to help a lot of clients with their peace of mind. So they don't feel that pain quite as much. Windward is also doing some things on our end. Drew, you want to talk about that?
Yeah. So, two of those things closer to the bottom about tax loss harvesting and Roth conversions. So tax loss harvesting is the opportunity to say, if you have investments in non-retirement accounts, so taxable accounts, can you sell something when it's down, buy something similar, and be able to have a way to kind of help your tax situation without getting out of the thing that hopefully will bounce back. So for our Windward clients, we look for those opportunities twice a month, and it provides substantial tax relief when the markets go down. That can give clients flexibility, tax savings, but the rules can be tricky. There's wash sales that people get kind of mixed up on quite a bit when they do it themselves. So best to work with a professional, make sure it gets done right. Roth conversions is the other thing. That Roth IRAs, we just think in general, are the best long-term investment vehicles that provide tax-free growth. And converting money from a traditional IRA or like a 401k to a Roth IRA in low tax brackets, it can significantly help a long-term plan. If you do a Roth conversion when the market is down, then you're getting to convert hopefully more shares on sale. So it can be kind of tricky to figure out, okay, how much should I do? When should I do it? But what we're just seeing with some clients who just know that it's probably a good idea to do some Roth conversion this year. Maybe we're doing just part of it right now. Could the market keep going down? Sure. But we know we're getting more shares by doing it now than, say, 6 months ago. That last point that's on there, avoid major mistakes, really is to be able to say, what's the action to consider? Don't do something major. Part of Windward's tagline is to say, develop a plan, save taxes, avoid major mistakes. Don't lean on the emotional feelings in a bear market. It's what happens to people in a bear market. They lose whatever long-term perspective they might briefly have had. So, Nick Murray, another awesome person in the advisory space, he kind of says, it begins with remembering what we're supposed to be invested for is not the near-term prices of stocks, but the long-term value of companies. So best not to do something drastic.
Yep, I agree with that. The last piece I'll say is, another tip is when we have a lot of clients that come in and they just feel anxious. So it could be a good time to take a break from the news. We all think it's important to stay informed, but sometimes, fear sells, and it can be helpful to step away, maybe create some boundaries about when and how much news you take in, because taking in all that information sometimes can cause more anxiety instead of less. So if you haven't already, please feel free to send us a question and we will try to answer it if we have time. I'll start with the first question. So I have an emergency fund. What are some ways I can earn interest?
Yeah, one kind of interesting opportunity that has not been a very popular idea I'd never really heard much about it until the way inflation has gone are I bonds. So they've made a lot more news recently, but I bonds are from the U.S. Treasury, and I stands for inflation. Because inflation has gone up so dramatically so quickly, they tie kind of their rate. One of the two ways that it's tied is to what's going on with the inflation rate. So right now, I bonds are paying out, nearly 9%, and that is a lot more than people can get in hardly any other place. There's caveats to it, though. It locks the money up for a year. You got to do it directly through Treasury Direct. So individuals have to do it themselves. Can't be done directly through an advisor. You give back some of that if you need the money sooner than 5 years, but that's one way.
Yeah, it's a way a lot of our clients have used for the first time, which has been good. I also think online savings accounts tend to pay higher interest than brick and mortar banks, and short-term CDs. If it's your emergency fund, we wouldn't want to tie it up in something like a 5 or 10 year term. But even a 3-month CD could be worth considering. Okay. If the market volatility is too much for me, what should I do?
Yeah, it's a good question. It kind of comes back to that, big idea of, just saying, hey, don't make a major mistake. I think, one thing that we like to do with our clients is to say, hey, let's look at the big picture financial plan with the software that we've built, that we update over time as your situation changes. as the markets change, and let's look at it with lower expected returns. Just the fact that markets are down likely means that the portfolio is down. Can your plan still work? That's the best place, I think, to start. The whole point of all of this is to say, is it to maximize returns, but is to say, can you get to where you're trying to go, even as things change? So that's the first place I think to start. Can things still work, or am I concerned when I don't necessarily have to be, because everything can still work? That's one thing.
Well, I agree. I think reaching out to your financial advisor is a good place to start if the market volatility is really getting to you, and trying to stick to the plan. It can be really hard. It's hard to look at your account and see it down, but those losses are only locked in if we sell. They're temporary. So
yeah, and I think it's worth saying, if I'm really panicked, what would be a way to make a small move that would add some comfort? It could be something more that you can control, to say, hey, we have some discretionary spending that we can adjust for right now, or a minor move, not a major move. Hey, I saw a question that I think is a good one to talk about. The question was, are there areas that you would invest in now, or would you wait it out more? I like that question. And how I'm reading that is kind of, just to be able to say, like, I got money. Is now the time to do it? Because if it's going to keep going down, I should wait till then. And the answer is, from a long-term perspective, if this is long-term money, I think it's likely a good time to go for it. Not because I know what's going to happen in the future, but because I believe in the long term of companies. But one way that some people who have had kind of some extra cash flow to invest, just with our clients here over the last couple months, is to say, what if I invest it over a certain period of time, or often called dollar cost average it in? So whenever you invest in your 401k at work, then you are dollar cost averaging. Some months you're buying more shares because the market was down. Some months you're buying fewer shares because the market was up. But having a plan to be able to get it invested, we say go for it, make it happen. But Windward, my last point is that Windward isn't specifically targeting any particular areas. Like, that is definitely where we should be invested. We're just generally saying, be invested in the global market, the U.S., the world economy. Over the long run, we're trying to capture the return everywhere, and not pinpoint any one specific area.
yeah, we definitely believe in a well-diversified portfolio. So we're not picking any individual investments, but I completely agree with Drew. I think it's, if nothing else, it's psychologically, you feel like you're winning if you're able to invest when the market's down, but we don't know when the bottom is. And so I think,
right,
picking a plan and sticking to it, maybe it's, I'm going to invest this chunk in 3 equal increments once a month, helps to feel like you're kind of getting closer to the bottom there, timing it. All right, one more question. I was planning to retire next year, but given the time to recover, am I going to have to work another 2 years? I really like this question. I've actually heard it a couple times in my personal life as well. I'll start by saying not necessarily. It really depends on what your financial plan looks like that you've worked with your financial planner on. Having the flexibility that you are able to work an additional year if you need to is an amazing lever to pull if you need it. But, if you have some cash set aside in your portfolio, depending on your spending habits, if it's able to withstand, withdrawals, it doesn't necessarily mean you have to wait to retire just because we are in a bear market. It really just depends on the circumstances.
Yeah, and there's no doubt that as people are getting to retirement and are in retirement, these kind of markets can just be so scary because, you know, you worked so hard to get to this point, and building a financial nest that then, you know, gets cut in value, it stinks. It feels so bad. And so there's nothing wrong with it. Just realizing that feeling and asking those questions, especially now, I think is really, really good. And, you know, to ask, okay, am I gonna have to work longer? Yeah, Brandon, I think you're exactly right. That the person that asked, you know, we know that you are a Windward client, so it'll be a good chance to come back in, talk to the team in your situation. But man, when we play what ifs with folks, of if we want the plans to have more cushion, one of the biggest levers that increases the cushion in a plan is an additional year of income. Because an additional year of income, especially if it's full-time income, is often a lot easier to navigate than if you shut it down and then are like, I'll just work part-time, and for, you know, often it's a significant pay cut, less benefits. It can be 5 years of maybe a job that isn't as attractive as it sounded when it's like, I'll just work at that place as a greeter. But important to consider and to see how things play out, which really just kind of speaks to that idea that we don't think financial planning should be a one-time thing. We don't do one-off financial plans with folks because life is fluid and the markets are fluid and they need adjustments all along the way. So good to work with the team as everything continues to change.
Yep, as client circumstances change. And I would just add that, you know, when we do build financial plans for clients, we factor in things like a bear market and a bull market, not because we can predict the future and we know that those things will, or when those things will happen, but that at some point they will. Over the course of a 40-year retirement, there could be multiple bear markets and multiple bull markets. So for our clients, bear markets like this are factored into your plan. All right, I think that covers it for today. If you're feeling anxious about the market, we definitely want to hear from you. Don't hesitate to reach out. We'd love to talk. This webinar has been recorded and it will be available on our website in the coming days. If you enjoyed it, feel free to share it with friends and family. We plan to hold more webinars in the future, so if there's a specific topic you'd like us to cover, let us know. You can pass your suggestions along to me. My email is on your screen and my phone number. We may cover your topic in the future. My phone number is not on there, but 913-601-3105. If you have questions about anything you heard today or would like to hear more about how Windward can help you, please reach out. We'd love to hear from you. Have a great afternoon and a safe holiday weekend.
Thank you.